Good morning, everybody. Thanks so much for joining us today. My name is Jessica Kapkar. I'm the communications manager at the BBB serving Central Ohio. I hope everybody is well and staying safe. It's a weird time for everybody, but we wanted to make sure that we let you know that we are still here. We're still here as a resource for businesses and consumers. And I wanted to make sure that everybody was aware of our one-stop shop for all resources on the local and national level. We have our new website, it's trustlocal.org, and that is where we are housing all of the information that we have been able to gather both locally and nationally. So if you have any questions, please feel free to visit that. There is also a survey that you can fill out that just lets us know kind of what you need, what your pressure points might be. You can feel free to look at that anytime. We're excited about this webinar today. I think it's going to be a great session. Glad to have Adam with us. He is going to be a wealth of knowledge for everybody. We are recording this webinar this morning, so please know that if you have any questions or want to reference back to it, we do have this recorded and it will be housed on trustlocal.org. We're going to have time for questions, so we'll hold on to those until the end. If you do have a question, please feel free to type it into the question box, excuse me, that you see. And with that, I'm going to go ahead and introduce Adam. Adam Koos is our host for this morning. He started his financial planning career 10 days before the World Trade Center was attacked. So that makes this the third stock market crash in his career. So I think he's going to have a lot of interesting insights for us. He is a certified financial planner with Libertas Wealth Management. And Adam, thanks so much for joining us. I'm glad to have you. And if there's anything else that you wanted to cover, please feel free to, introduce yourself a little more, and I'll turn it over to you.
All right. Well, no, thanks so much for asking me to do this. This is going to be a lot of fun. Hopefully, everybody gets some value out of it. I'm going to go over our agenda just briefly here so we can kind of see what we're going to talk about today. So first and foremost, as the invitation stated, we'll talk a little bit about how to stay positive, cup half full, how to turn crisis into opportunity, because there's no shortage of bad news out there right now. And I think that there's no doubt everyone is scared. Some people have had their income slashed. Many people have had their jobs completely lost altogether. They don't know if they're going to get hired back. So obviously we want to stay away from the bad news and stay positive here today. So we're going to talk about some things that maybe, again, are cup half full. I want to talk about now is a perfect time with over 30 million people unemployed and obviously a pandemic. Now's a good time to start getting our financial house in order. I think a lot of times we as human beings tend to procrastinate on certain things. And I think when it comes to certain financial things or things that involve mortality, perhaps, it's not fun to talk about. So we'll talk a little bit about that. Talk a little bit about how to protect yourself from an economic aftershock. And what I mean by that is I like to look at this pandemic, the coronavirus, as call it an earthquake, if you will. And when you have earthquakes, many times you can have aftershocks. And while we might be coming to an end here in terms of finding a vaccine, hopefully in the not too distant future, I'm being told by the physicians that I know that, we'd be lucky to get something in 6 months, but nevertheless, once things start to slow down and we start seeing fewer and fewer people dying in new cases from the coronavirus, I do think that we still are going to have some sort of economic aftershock here once people start going back to work and we see how things are going to play out in that front. So we'll talk a lot. This is going to be a lot kind of aimed at business owners more than anything. And then last but not least, I'm going to go over kind of a stock market update, and I'll get more into detail when we get there. But kind of how to protect your retirement savings as this country tries to claw its way out of a probable recession. I'm not going to say definite, and I don't even want to say possible, because I think it's pretty probable that we do find ourselves in a recession here in the not too distant future. And then, as mentioned earlier, we'll have a Q&A at the end and answer any questions anyone has. So let's go ahead and jump into it here. So creating, again, cup half full, creating crisis and taking crisis and turning it into opportunity. First and foremost, RMDs. So for anybody who has inherited IRAs, for anybody who is over 70 years of age or turns 70 and a half years of age prior to January 1st of this year, there is no RMDs this year. So if you're concerned about the taxes that you'd have to pay for tax year 2020. You don't have to take those RMDs out. Same with, again, inherited RMDs for people who are younger. There's no need to take that money out and no need to pay the tax unless, of course, you need the money. So that's one thing that's happened that's been a positive. Second, for younger people, people who still have student loans, utilize the federal student loan protection program. So reach out, make a phone call, ask for deferment, and interest in many cases has been waived. So that's another benefit or cup half full item going on here in the economy right now as a result of the coronavirus. Roth IRA conversions, I've seen a lot of this, and it does, if I'm being honest, it does bother me a little bit. So Roth IRA conversions are the process of taking your pre-tax traditional IRA or pre-tax old 401ks, paying the taxes on them and converting them to after-tax Roth IRAs that you never have to pay taxes on in the future. Of course, the catch, it sounds beautiful, right? You know, you have this pre-tax IRA or this pre-tax 401k that you've never paid taxes on, and when you take that money out at or during retirement, you have to pay tax when you pull the money out. So when somebody says, well, now's a good time because the market's down, your portfolio is probably down in value, now's a good time to convert that to a Roth IRA where it now becomes an after-tax tax deferred vehicle that you never have to pay federal, state, or local tax on. That sounds great in theory until you realize the punchline is you have to pay the tax, of course. So there's a lot of ways to skin the cat, as they say, and the one thing to keep in mind, in my opinion, and again, this is just my opinion, that many times Roth IRA conversions don't make sense, but it all depends on your personal situation. It depends on whether or not you have cash on the sidelines to pay the tax. I don't like to see people convert an IRA to a Roth IRA and just take money out of the IRA to pay the tax. But that all being said, this could make sense for you in 2020 again, due to the fact that the market has seen a pretty big decline. Tax loss harvesting. So having nothing to do with IRAs, retirement accounts, Roth IRAs, and so on, if you have after-tax, in other words, non-qualified accounts, and you've owned some investments that maybe haven't performed so well, or maybe you have losses, what you can do is you can sell those investments and take a loss in, say, the current tax year for 2020, and then down the road, when you have a gain, you can worry about washing out that gain with a loss. So here's an example. Let's just say, I don't know, let's just say you have a gain of $10,000, just to keep numbers simple. And as a result of the coronavirus and the preceding market crash, you've got, I don't know, a bunch of investments that you own that have a loss of $10,000. If you sell those investments or that investment, you have now washed out the gain from earlier in the year. This can obviously get a little bit more complicated when we start talking about tax returns, carry forwards, and things of that nature. But again, just one other positive here is that there are some good things that can come out of being defensive and protecting your assets, and if you were to sell investments that are poor and that are underperforming. Life insurance, this is kind of big. I don't think that most people understand how life insurance is constructed. Now with term insurance, it's a term. It's basically you buy insurance at a certain death benefit for a certain number of years. So you buy a $1 million term policy for 20 years. It's $1 million for 20 years, and you pay the premium until you don't, or until it lapses, and that's it. But with permanent insurance, and what I mean by that is whole life insurance, universal life insurance, these permanent policies that have cash value, especially if you've had policies since, say, the early 2000s, the 90s, or even worse yet, than the 80s. When an insurance policy is built, it's illustrated internally based on the interest rates at that time. So because we're sitting at record low interest rates these days, now would be a great time to have what's called an in-force illustration done. And all you have to do is call the insurance company, ask for an in-force illustration. They'll email it to you or fax it to you or mail it to you, depending on the insurance company in question. And what you can do is if you don't want to look at it, you can get it to your financial professional, your financial advisor or insurance agent, and they can kind of look at the inside or the vital signs of that insurance policy to find out if it's still performing well. And I know it sounds weird to think, well, wait a minute, life insurance doesn't perform. But in fact, if a life insurance policy you purchased back in 1995 was illustrated using rates at 6, 7, 8%, but now we've got much lower rates today, there's a good chance that you could actually get more death benefit, or you could get a lower premium, or perhaps even no premium at all, just by doing what's called a 1035 exchange and getting rid of the old insurance policy and replacing it with a new one. So now is a great time to be reviewing your insurance. And again, it's something I think people just don't think too much about. Another one, this is almost, we just talked about rates, so this should almost go without saying. I'm not saying that everyone should refinance their mortgage. We were just talking to a new client yesterday who, when they purchased their home back in 2014, they managed to get a 3.5% rate, which is incredible. So if your rate's already incredibly low, obviously this might not make any sense at all. However, I think it would make a lot of sense to talk to a reputable mortgage advisor, find out what the closing costs would be, find out what your payment would do, and then of course get a break-even analysis, which is just simply saying, okay, based on the amount it would cost to refinance, in other words, the closing costs, how long would it take me to break even on that cost and the lower payment I would receive? And of course, you want that break even to be shorter than when you would move and sell the home, of course. You don't want to, refinance your house and find out that you're going to move in 3 years and that your break even would be 6, in other words. So now's a great time to be evaluating your mortgage. Commercial property. So this is kind of more people who own commercial buildings, commercial property of any kind, really. If you have an SBA loan, there is a program out there that's new that is relatively unknown that they're offering a 6-month forgiveness program. And that's not like some of these programs where they I wouldn't say refinance, where they re-amortize your loan. So they're not re-amortizing without penalty. What they're doing here is the federal government, through the stimulus packages, are actually paying for the mortgage. So principal interest would be paid for by the SBA via the government. So if you own commercial property and you have an SBA loan, reach out to your commercial banker and find out whether or not you would qualify for that. And then if you're one of the people, and this isn't for business owners, obviously this is for individuals, if you've been laid off, if you've been furloughed, don't wait. Stay, as one of my clients said to me a long time ago, and I've always kind of used this quote over and over again, and stay ahead of traffic. You don't want to just sit there and coast in the middle lane and let everybody pass you by. Now is a good time to be getting on LinkedIn, networking with other people, looking for opportunities for jobs. And even if you're a business owner that maybe, unfortunately, as horrible as it might sound, didn't make it or isn't going to make it through this thing, now's a good time to be staying ahead of traffic and meeting people and trying to find new opportunities going forward. So that's that. Let's change gears here and kind of talk about getting your financial house in order. So the first thing, and some of this stuff's kind of old hat, but I'm going to say it anyway, and especially if you've lost your job or if you're struggling as a business owner, building an emergency account probably is the last thing on your list right now. But I still have to say it. So I mean, we always want to be our own credit card. We don't want to use debt. There's a lot of talk going on right now about people not paying their credit cards. Obviously, you pay your rent, your mortgage, you pay maybe your car payment, your utilities, gas, electric, food. Obviously, you have to survive. But the first stuff that starts to go is things like credit cards and things of that nature. So you want to be your own credit card for as long as you can. And then when that cash is out, of course, we have to resort to other measures. However, if you have the opportunity or the ability, whether that's now or in the future, to build an emergency account, that's the first thing that we would want to do. And 3 months for two working, a couple where there's 2 working parties in the household, minimum of 6 if there's just 1 working person in the household. If you're retired, more like 12 or more. Call your mortgage holder. So whoever holds your mortgage, and this goes for residential or commercial, SBA or not, there are some relief options out there, and there's some companies that are being very lenient when it comes to people who are being proactive and not just, in other words, don't just not pay your mortgage, give your mortgage holder a call. And there's some programs out there and people that can help you out. I hate this, but play the balance transfer game. If you do have credit cards, again, credit card companies, banks are going to suffer as people stop paying their bills. So try to play that balance transfer game. And the sooner you get ahead of traffic with this as well, the better off you'll be. So try to find that 0% card, look for ways to consolidate debt, anything to keep your cash flow positive. Now is also a great time to get a second opinion on your home and auto insurance. So obviously people really aren't driving all that much right now. I'm not saying that we're going to go right back to normal, but chances are we probably won't. There's going to be a whole lot more people working from home than ever before. So look for an independent agent. If you'd like a recommendation, I'd be happy to share one. I won't do it on this call, but get a second opinion. I mean, the worst case scenario, you find out you're in great shape and there's nothing to do at all. Big picture, I know we all are kind of sick of being at home. We don't want to look at the 4 walls in our house anymore in our living room, but try to skip carry out, maybe cook from home. Not only is it a good way to tighten your purse strings, but it's a good way to maybe hit some of those fitness goals and work-life balance too. So it's kind of a win-win. Beware of scams. So this is really new. Literally in the last week, I've started to receive emails from people saying that there are scams now being started, unfortunately, where people are trying to take advantage of these relief programs and pretend like they're one of them when they're not. So if you get one of these emails, don't respond to an email with bank account information. Don't respond with any personal identifiable information. You definitely keep your stuff close to vest. If you're curious about whether or not the plan's legit, I would reach out to the Better Business Bureau. I would pick up the phone and call the entity in question that's showing up in your email inbox or your mailbox, and proactively give them a call. But don't respond to phone calls, and give information to people that ask for it, and don't respond to emails. Cancel wasted subscriptions. Now, some of these things, I didn't put Netflix on here because I know that my wife and I have been using Netflix like it's going out of style. But you know, Spotify, if you have a subscription, Pandora, Audible, YouTube Premium, anything that you cancel is obviously temporary. You can have it back later on someday. Some of these things like, Audible, for instance, I know that there's apps that you can use where you can literally get audiobooks, books that you read for free from the public library without having to even go to the library. So anything you can to, again, tighten those purse strings. And then kind of a big segue here, update your estate plan. And when I was talking earlier about mortality and how it's no fun to talk about it, uh, we all say it's not going to happen to us, but the fact is it can happen to us, and we have to protect our family. So I'm going to make this segue here and tell you just a really, really brief story. I don't want to get into too much detail, but 2.5 years ago, I lost my brother. He fell asleep on his motorcycle, passed away, and left his 4 kids, one of which is autistic, and he was between jobs, so he had no life insurance, no healthcare directive, no powers of attorney, no will, nothing. And it was up to me, obviously being the financial planner in the family, to pick up the pieces and try to fix this thing and put the puzzle back together for he and his family. So obviously a rough time, but one of the things I realized back then was that I hadn't done, I don't want to say anything. I mean, we had a will, living will, powers of attorney, healthcare directive for ourselves, but there was a lot of other things we didn't have. So, if heaven forbid, I always say, it's not going to happen to me, but if heaven forbid something happened to me, then my wife would be in shambles in terms of how do we pay the bills? What subscriptions do we have? What are the passwords? So one of the things we started doing was making a promise to our clients after we got our house in order to make sure that they never went through the same kind of thing that I had to go through, or that my brother's family had to go through. So estate planning documents go without saying. Again, healthcare directives, powers of attorney, will, living will, trust documents, medical power of attorney, medications and supplements. Car accidents, while we're not driving a whole lot, are one of the leading causes of hospital visits. And if you're taking medications or something that the first responders are concerned about, and they don't want to give you any drugs that might save your life because they don't know what you're taking, that's a problem, obviously. So financial information, insurance, property and titles. I mentioned online accounts and passwords. So again, if I were to pass away, I want to make sure that my wife would be able to jump right into my seat, log into all of our accounts, pay our bills, not just for home, but for the business as well. Memberships, subscriptions, we don't want to, well, if I have a bunch of things I'm paying for that my wife doesn't need anymore, we don't want to be paying for those things any longer. And then I mentioned first responders, we have this thing called an ICE key. It's basically a USB key that we would put, medical power of attorneys on, medications and supplements, things of that nature, so that if we were to end up in an accident, or say if I were to end up incapacitated, a first responder could plug that USB key on my keychain directly into a laptop and find out what my details are with regard to my health, to make sure they could start helping to save my life as soon as possible. So that's that. So I can't reiterate more though. I believe the last number I saw is 52% of people don't have an estate plan at all. And I'm not going to call that crazy because it's more than half, right? So I mean, the majority of people don't have one. And I think that if you're one of those people, you're obviously not alone. So during this pandemic, during a time when things are very uncertain, obviously you got a disease that's running around. Unfortunately, people are being affected, families. I think now is a great time to start getting some of these things in order, so that if the worst were to happen to you and your family, that you'd be covered and that you wouldn't have to go through some of those worries. Or in other words, don't wait to step on a landmine before you prepare for this kind of stuff. All right, changing gears again, protecting ourselves from that economic aftershock. So this is more aimed at business owners than anything else. First and foremost, most of us plan our budget at the end of the year for the next year. And I'm sure, I don't know about you, I mean, I saw this meme going around that said, This has been the strangest leap year ever, that there was 29 days in February, there was 31 days in March, is that right? I have to do the knuckle thing, but there was 5 years in April.
Yep.
So it's definitely felt like it's been a long time. I keep thinking it's July and it's not. But I think now is a good time to start evaluating your budget and trying to kind of hit the reset button. Things have changed, people have changed, behavior is going to change, and your customers are going to understand. I think that goes without saying. Kind of going on the same lines as the safe haven kit I mentioned on the last slide, succession planning. What happens to your company when you're gone? What happens to your employees? What happens to your family? How are they taken care of if something happens to you? So now again, kind of like the estate plan, now is a great time to be getting those buy-sell agreements in order, figuring out what your succession plan is. Heaven forbid something happens to you. And if you're not in business and you're not working at all, spend your time doing stuff like this so that you don't have to worry about it later. Because when things do get back to normal, however long that will take, you're not going to have any time anymore. So take care of this stuff now. Economic relief programs, this is beyond the scope of this presentation. I know that the BVB has already done and probably will do more presentations with regard to different programs like the PPP. So I don't want to talk about that on this presentation, but make sure you're just staying ahead of the game and taking advantage. One tip that I heard recently is that if you're going to take advantage of any sort of stimulus package, to make sure that you're going to maybe one of the regional banks. So instead of going to the huge mega, behemoth banks that have a lot of inefficiencies because they're so big and there's so many people, you might have a whole lot more luck seeing your stimulus loans and forgiveness loans and things like that be approved if you go through a smaller bank that maybe is a little bit more efficient and has a lot more personal service. If you're a business owner, again, examine, I mentioned earlier, if you've been furloughed or laid off, stay ahead of traffic. If you're a business owner, on the other side of the coin, obviously you have to examine what's best for you based on your industry, your sector, and your business, and your family. So, examine whether furloughs make sense, layoffs, and if you didn't get a chance to get the PPP loan, hopefully there'll be more opportunities going forward. Retirement plan options. One of the questions I've gotten a lot is, should we stop our 401k contributions? Obviously, 401ks are long-term. Their retirement plan, whether it's a simple SEP, 401k, what have you, these are things that are supposed to be spent down the road when you hit retirement. So if you're putting money into a 401k, as much as it pains me to say this, if you've got cash flow issues, maybe now's a good time to just take a break and give it some time and keep your cash flow. Same with your match. Now you have to talk to your TPA, whoever manages your 401k plan for you. But if there's going to be some long-term issues in your 401k plan, maybe it makes sense to suspend your match, again, just to keep your company's cash flow positive. On the employee front and employer front, one of the things that have happened as a result of the coronavirus is that they've doubled the amount of loans you can take from a 401k. So now you can borrow up to $100,000 from a 401k. Obviously, interest, you're going to pay yourself interest and have to pay that thing back. So be really careful here. If you need 50 grand, don't go borrowing 100. Only borrow what you need. But that is an option as well. Play defense, stay in business. I think everyone's trying to do that, so you don't need me to tell you. But do everything you possibly can to protect what you've built, and obviously to protect your family. And once you've done all the defense you can, and there's nothing left to do from a defensive standpoint, play offense. Get creative. Ask Father Google, Google ideas that other companies in your industry are doing around the country to stay alive, to get creative and rekindle that entrepreneurial fire. Take this, use this challenge or this, I don't know, this tough time is gasoline for your entrepreneurial fire. Take advantage of this and really get competitive with yourself. I've got a big long checklist that I'm happy to give away to anybody who wants it for free. There's no catch. So I'll let Jessica take care of this in terms of how to administer it or how to get this checklist. But it's a big long list that I can email you. It involves personal planning, coronavirus relief package. I won't read all of this, but stuff for liquidity, tax planning, insurance, business continuity, finances, customers, employees, community, leadership, and so on. So kind of a big, huge, comprehensive list that I'm happy to share with you that'll help you kind of get that defensive part taken care of as you switch to offense. All right. Take a drink here. Next, I'm going to go into some relatively nerdy charts and some pictures about the stock market. And before I do that, I just want to kind of throw a little caveat out that the way I manage portfolios, retirement portfolios at my office is a little different than most, in that I'm a trend follower, and then I'll get into the details of that in a second. So, but in a nutshell, what you're about to see is probably going to be different than most of what you're used to. So, before we jump into that, though, one of the first things that I think you can be doing right now, the market hadn't crashed in 11 years, which means if you think of that from the standpoint of the average age of somebody who puts money into a 401k, average person puts money in a 401k or starts a 401k between 25 and 30 years of age. We'll just say 28. So if the average person puts money into a 401k at 28 years of age, and the last market crash bottomed 11 years ago, that means that you have to be 39 years of age to have started putting money away at the bottom of the last crash. In other words, nobody under the age of 40 even knows what it feels like to go through a real market crash. As Jess mentioned earlier, this is my third one that I've been through. I don't want to say unfortunately, I actually feel very fortunate to have had that experience. But so I know how this feels, and I think that whoever invented the phrase slow motion train wreck was probably involved in the markets, because that's kind of how it works. It's not, I think we're used to this last 11 years, we're used to the market going down, for 3 months, and then it comes back 4 months later. Or, like in 2015, 16, it goes down for a few months, comes back, goes down for a few months, comes right back again. I also think that, when you look back to 2018, 19, the market goes down almost 20% in 90 days, and it comes back in 42 days. That's not really normal. So I think that we have to kind of reprogram our brains and get back to what might be the real normal here, or the new normal, which is really just the old normal. Markets aren't supposed to go up for 11 straight years without resetting and digesting gains. So without getting too nerdy here, one of the first things I think that we should do is, if you've been investing for the last 11 years and you're used to the market just rebounding and going right back up again, now is a great time to reevaluate how you behaviorally think about money when it comes to investing. And one of the pieces of software we use is called Riskalyze. And what it does is it attributes, using just taking 5-question survey, it attributes a speed limit to how fast you drive your retirement plan. And if you want to take the quiz, it's free. Again, no catches or anything like that. If you go to our webpage, it's right at the top here, and you can see that free portfolio risk analysis. And the reason I say now's a good time to do that is because if we're used to the market going up for 11 years, and every time it goes down briefly, it comes right back, I think that we can get maybe a little greedy. And I'm not saying that's a bad thing. I just think that it's a matter of little behavioral heuristic called recency bias. If we don't realize that if after 11 years the market never crashes, we get to this idea subconsciously that it's just never going to crash. So I think that it's important to hit that reset button ourselves, for our businesses, for our families, and to make sure that we're not taking too much risk, because when you build a retirement plan, financial plan, estate plan for your family and for your business, the number one detriment to that plan is you. If you don't stick to the plan, if you put together a retirement portfolio that's too risky, and when the volatility gets too hot, you want to run out of the kitchen, then the plan's not going to work. It's just not going to end up like you want it to in the long run. So feel free to check that out. All right, so I'm going to get a little bit nerdy here. First thing I want to explain is to explain to you what I don't do. So oftentimes people say market timing. I'm not a trend predictor. I'm literally, you can't see my face right now, but I'm looking over at my table in my office, and there's a crystal ball sitting on this table, and it was a joke get from a client, because it doesn't work. I wish it did, but it doesn't. And but I do not predict what the market's going to do next week, next month, next year. I have no idea what the market's going to do, but I do implement technical analysis and trend following into my portfolio management strategies for our clients. Which means, again, what you're about to see is probably a lot different than what you're used to seeing. In other words, I don't really believe in the concept of diversifying, buying and holding on for the long term. I guess it's kind of the antithesis to that. So, it's, if you think of it like sports, while we don't know if we're going to have any sports coming up here, I don't believe in just taking our money and investing in every team in the NFL and then just letting it go and seeing what happens. So if we're not going to have a season, I don't want to be invested in the NFL. And it's the same thing with investments. If we're in the midst of a market crash, if the market's in a downtrend, I don't want to be invested in the market. And one of my friends, Arthur Hill, recently said this to me a few weeks ago, actually. He said, stock market crashes are like taking your boat out in a hurricane. Either you better have a pretty incredible boat, or you better be a really good skipper. So market crashes are typically about 7 years is the market cycle. So in other words, usually We see the market go up for 7 years, and then we see a reset. We see a market crash. The average crash is about 42%, half are better, half are worse. So what I'm trying to do in our strategies, I'm not trying to buy at the bottom, I'm not trying to sell at the top. I'm trying to buy on the way up the hill and capture as much of the long-term uptrend as humanly possible. Furthermore, when the market starts to crash, I'm not going to sell at the top again, because that crystal ball does not work. I wish it did, but it doesn't. And then we're going to ideally miss as much of the downtrend as we possibly can. Now, this market crash, actually the initial decline, the waterfall decline, was faster than what we saw during the Great Depression. So it was really hard to get out as early as I would have liked to, but the trend is still very much down. And I think we have to be really, really careful thinking that just because the market bounced means it's going to just scream right back to new all-time highs, and I'll explain why. But the benefits of trend following, understanding it is an imperfect strategy, because there is no such thing as a perfect investment strategy, but first of all, it works in an uptrend. This is the 90s, the longest bull market in history. And by the way, the reason they call them bull markets and bear markets is because bulls attack with their horns from the bottom up, and bulls and bears attack with their claws from the top down. So if you want to end this call and move on with the rest of your life, maybe you've learned everything you need to know. But anyway, so this is a bull market, the longest bull market in history in the 90s until the dot-com bubble. This is the mortgage crisis. So trend following works really, really well during a downtrend, during a market crash. Here's October of 2007. So we did not sell at the top, but here's where we would have sold in your portfolio on the way down the hill. Now here's the imperfection. The imperfection is that when markets go down, like they did 19.9% in the fourth quarter of 2018, here's where we sold out of the market. And then because it came back in 42 days, it came back entirely too fast to get back in at a same or lower price. It's very frustrating, but I can't reiterate more. There's no such thing as a perfect strategy. If you're looking for a perfect investment strategy, you will search for the rest of your life and never find one. So for me, my philosophy is simply that given the worst case scenario, I would rather underperform during a whipsaw and what I call tornado sirens that don't turn into tornadoes than to participate in the full brunt of a market crash like 2000, 2001, 2002, or 2007, 8, and 9, and just sit around and do nothing. I guess that's my opinion. Maybe unpopular. So one of the questions I might get is, well, what about missing the best days in the market? Because there's research out there that says, if you stay in the market the entire time, and I'm making these numbers up, by the way, but if you stay in the market the entire time and you don't do anything at all, then you might make 10% per year over the last 30 years. But if you miss the best 10 days, now your return goes down to 7%. If you miss the best 20 days, maybe your return goes down to 4%. If you miss the best 30 days in the market during that time frame, maybe you're only making 1 or 2%. So the theory is, well, you just need to stay in the market all the time. But what I would challenge you is, when I started in this business, I was trained to do just that. Find clients, diversify their retirement portfolios, and then go find more clients. And then when the market's crashed, to say it'll be okay, it'll come back, and you haven't lost anything unless you sell it. My opinion these days, and as has been the case since 2008, is that you haven't made anything unless you sell it. So if you miss the best days in the market, one of the things people don't realize is the people doing this research and putting it out there, of course, are mutual funds. And think about this for a second. If you're a mutual fund company or an ETF company, why would you want anybody to sell? Because if you sell, then they don't get paid, right? So one of the studies that have been, well, not one of the studies, many studies that are out there, you can look them up. I'm happy to share them with you if Jess connects us, is that most of the best days in the market actually occur within days of the worst days in the market. But you don't see research out there that says, what if you miss the worst days in the market? How do those numbers come out? But what I will show you here, because I want to keep things simple, or at least as simple as possible, is that most of the best days in the market happen during downtrends. So this dotted line is just a 200-day trend of the stock market. And as you can see, going back to 1993, most of the best days are below that trend line. So the lesson here isn't so much to stay in the market because we don't want to miss the best days. The message is more, just don't invest when we're in a downtrend. And then again, look at how close the worst days are to the best days. And here's just basically $1 invested back in 1993. If you missed the best 25 days, that dollar only grew 100%. In 2020, it only grew to $2. If you missed the best 25 days and the 25 worst days, you can see here, it grew to $10.82 versus just staying in the market the entire time. And what I would argue is if we go back, not only do we have the ability to get healthy returns over the long term by staying invested only when the trend is up and not when the trend is down. In other words, being invested in our retirement portfolios when the wind is at our back, not when it's in our face. But we have the opportunity to do so with a whole lot less risk. So that's my tee up for everything else I'm about to teach you here just briefly. So I mentioned tornado sirens earlier. The way I have a bunch of indicators that I use to determine whether or not we're in a risk on environment or a risk off environment. Risk on just simply means that the coast is clear, the market's hitting on all cylinders, and it's safe to be invested. Risk off means that the market's not safe and there's enough negativity going on underneath the surface. In other words, kind of like a doctor's patient who walks in and looks fine on the surface. When you take the blood pressure of the patient, when you take blood pressure, I'm not sure I just said blood pressure. Blood pressure, do blood work, X-rays, CT scans, EKG, and you find out inside the patient that there's maybe a tumor or that there's something else going on that maybe could be fatal. That's what the kind of stuff that I'm looking at. Now, when you look back at history, all these rose shaded areas, these vertical rose shaded areas, are times when there was a tornado siren, we're going to say. In other words, we had to, if our kids are our investments, we had to take our kids to the basement. And every time we had one of these rose shaded areas, like in 1998, where a tornado never showed up, we underperformed and we feel stupid. Because after the fact, we're like, man, I should have just stayed there. I should have just stayed and kept hitting my DVR and not missed out on the game. And now my friends are text messaging me and saying, hey, did you see that touchdown? And I'm saying, well, no, I went to the basement. You didn't go to the basement? It's like, oh, I never go to the basement. There's never tornadoes. But as you can see in 2000, obviously the siren went off and we had a huge tornado that wiped out 47% of the market's value. Another tornado siren here in 2006, it was only about 2 weeks long is all. And then in 2007, tornado siren and a huge tornado that wipes out 58% of the market's value. And this is what I was referring to earlier when I say that this second longest bull market in history that we just went through that just ended in February, we can now say it ended in February, has sent 1, 2, 3, 4, 5, 6 tornado sirens without a tornado. In other words, every 18 months on average, there's been a tornado, but no tornado siren, but no tornadoes. So now we finally have this tornado that's actually shown up. We don't know how bad it's going to get. Again, you're not going to hear me predict anything. I have no idea what's going to happen. But all we can do is we can look at the risk-reward landscape today as it stands and determine what is that risk? Is it worth being invested in stocks, and why? So let's move on and talk about that. Right now, the market went down huge, right? The fastest initial waterfall decline since before the Great Depression. There's never been a decline this fast in history. So then it makes complete sense that it would bounce really fast. It's kind of like if you go outside and you take one of those bouncy balls we used to play with when we were kids and you hold your hand out and you drop it, it's going to bounce. It's not going to make it back up to your hand, but it'll bounce. Now, if you walk up to your second floor and you drop that ball, it's going to bounce a whole lot bigger. And the same is the case here with the stock market. We're entering what I would call the danger zone, which is an area where psychologically a lot of people over the last 2 years have invested their money in the market. So back here in January of 08, at the peak in September, 18, at the peak of the market in September 18, we've got the peak here in May of 2019. So everybody who's invested money this last 2 years in these areas think of it like walking into a casino. And I hate to use that analogy, but it is what it is. And let's just say you walk in and the first thing that happens is you invest up here and then your $1,000 is worth 650 bucks. And then very quickly after that, you make it back up to about $900. Are you just going to keep playing and try to make money, or are you maybe going to want to walk away? Maybe you want to just say, okay, I've had enough of this. This isn't as fun as I hoped it would be today. Maybe I'm just having bad luck. So if you look back at all these circles, these are times when people would have invested that they're looking at now potential break-even points where maybe they don't want to take this kind of risk, especially when you consider the news that's going on in the market right now with, I keep calling it the economic aftershock, or the economic shock wave, if you will. But right now we're in this danger zone where we've got a declining long-term trend. This is the 200-day moving average. So a declining long-term trend. We've got a declining 50-day moving average, which the market's above that now, which is great. But the long-term trend is still down. In other words, once it's down, one of my friends, Brian Shannon, always says this, coined the phrase, it's guilty until proven innocent. And when the market's in an uptrend, it's innocent until proven guilty. So right now, as long as we're in a downtrend, any bounce that we see in the market needs to be taken with great caution. We don't want to assume that just because for the last 11 years, the market has bounced back in a matter of months, that it's going to happen this time. And if you want to take that bet, be my guest, but I'm not willing to do that. Here's an example of how bad things could get. I'm not saying they will. I want to be crystal clear here. I'm not predicting anything. But the 1987 crash went down 33.4%. And you can see how low that was compared to the current market. 2000, 2002, this is how low we would have had to go. 73, 74, this is how low that would have been. And then 2007 and 2009, the 1400, call it 1430 mark on the S&P 500 is how low we would have to get to see a crash of that magnitude. But understand, and now is probably a great time to tell you this, real market crashes, not these corrections that come back in 4 months, but real, normal, healthy, I hate to say healthy, but healthy, normal market crashes that reset the stock market take time. The average market crash takes between 16 and 18 months, not 4, not 5, not 6 even. Now, there's a lot of talk that maybe this market crash, because it went down so fast, that maybe it could recover quickly. And I really do hope it does, honestly. But that all being said, what we have to understand is that we are playing with averages. And one of my favorite mathematical jokes is about the guy who drowned in the river that was an average of 4 feet deep, right? So I can't hear you laugh. Hopefully somebody laughed at that joke.
I'm sorry.
Anyway,
I muted myself just in
thank
case.
you, Jess. I appreciate it. I don't have an audience. But anyway, my point is that if this market crash is anything like 2007, 8, and 9, which lasted 18 months, that would mean the bottom would come sometime around August of 2021. If it's anything like 2000, 2001, 2002, that would mean that the bottom would occur sometime around February of 2022. So again, I'm not saying that the market crash is going to last that long. I don't know. I have no idea. All I'm doing is looking at risk reward characteristics, whether or not we're in an up or a downtrend. I'm evaluating 13 different indicators that I follow to determine whether or not we should be in the market or not. In other words, whether risk levels are too high to be in or too low not to be in. But here's another lesson. These bounces that we see in the market are normal. When the market's going up, when the market is in a healthy uptrend, just like it was in 2017, we don't see huge 12% bounces. So this is the market going back to 2007, 8, and 9. Market goes down 18.6%, but it bounces 12. And people say, well, look, it's over. You know, it's market crash is over. Now it's a great buying opportunity. Now's a good time to buy. And maybe it was back then. But then it goes down 37%. And then people start saying to themselves, well, maybe now's the best buying opportunity. It can't go any lower than this. And then it bounces 11%. It goes down 15. Say, well, it definitely can't go any lower than this now. It's got to come back. And then it goes up to 18 and a half. And it goes, see, I told you it was going to come back. Then it goes down 25. And they go, well, God, if it's gone down another 25%, it can't go any lower. Then it goes up 24. And they say, see, I told you so. And then it goes down 25%. And finally, the market does bottom and heads to new all-time highs eventually. But throughout this process, the psychological terror that goes on in the minds of investors as they try to figure out, you know, whether they should stay invested, whether they should buy or treat these dips as buying opportunities. Now, let me back up for a second. If you're a long-term investor and you're 25, 30 years of age, you probably don't care about any of this, honestly. Somebody who has, 30 years before retirement and another 40 years to live can buy into any point in this market and they'll probably be fine in 30 years from now. But for those people who are 50, 55, 60 and older, I think these are the people that need to be paying attention to this stuff. And this is the same thing, except it's 2000, 2001, 2002. I won't go through it as slow as I did last time because I'm starting to run out of time here. But market goes down initially 11%, bounces 12. Goes down 27%, people say, oh, it can't go any lower. Goes up 19, see, I told you so. Wait, now it's down 26. Definitely can't go any lower than this. Up 21. See, we're back to even. In fact, we get 1 high, 2 highs, 3 highs. Things will be fine now. And then it goes down 32%. And you can see how this plays out. So the lesson here is that when the market's in a healthy uptrend, you don't tend to see these huge up moves. The huge up moves, the huge bounces happen during market crashes. It's quite the opposite, actually. So when and how will the market bottom? I already told you I'm not going to predict anything. So unfortunately, that's not going to happen today. But I'm going to give you a few scenarios. The first scenario is that we have what's called a V bottom. The market just goes down, comes right back and screams to new highs, just like it did 2018, 2019. I think this is the lowest probability outcome, but anything can happen. I have an open mind, and if I need to get back into the market at a higher price, I'll do that. But I'm not going to gamble. I'm not going to take bets when the probabilities are low. The second possibility, which I think is a much higher possibility, is that we had the first decline and that we have a W bottom. So we get a bounce and then it goes back down again. Maybe not necessarily this low, I don't know. But again, then we head to new highs after that. So we have I'm just playing with numbers here, but we have the coronavirus impact. Then we have a bounce once we start to see things reopen. And then maybe what we have is something to the effect of like an economic aftershock or shock wave that occurs. And then once that's over with, we head to new highs. Another option is that we have an L bottom where, this was Black Monday in 1987, huge drop, not too different from what we saw this year. But then we kind of see this kind of choppiness, a bunch of bounces, but eventually over time, it whimpers back to new highs. I think that's a possibility. But there's also another possibility as well that we have another leg lower. In other words, the market goes down, it bounces, kind of heads to retest these lows, and then heads lower again, bounces lower again. And again, one thing we always have to admit to ourselves, myself included, is that I have no idea what's going to happen. And I think investors, we humans are the worst investors in the world because we have brains, and we have to make sure we're not exhibiting any biases. We can't say that because we're invested in the market and because we want it to go back, therefore it will, if that makes sense. So we can't say, well, I disagree with you, Adam. I think what you're saying is complete trash. But you're probably only saying that because you have a hope or you have something that you want to have happen. But patience is the key here. So this is a fun chart. It's like a mystery chart. Kind of gave it away with the date down below. But here, let's just say today, this is the market today. We get a huge decline and then we get a bounce. And this looks a lot like the market today, because if you pull up a chart right now on your own at stockcharts.com and put the 200-day moving average, we're butting up against the 200-day moving average. But we have to be patient, and this is why. Because as much as this might bring confidence and make us feel really, really good about the prospects for new market highs and a recovery and things getting better, this is where that point was if we scan out. So this is the 2000, 2001, 2002 crash, and all of a sudden we're going, oh man, I wish I would have. And the reason for all this is just based on the sequence of returns. A lot of people don't understand that when you lose money, you have to make a whole lot more to get back to even. If you lose half of your money, $1 million is worth $500,000. It takes a 100% to get back to even. And I'll run through the math real quick. If you have $1 million and you lose half, obviously it's worth $500,000. If you make 50%, that's only 250,000. So you're only back to 750, not $1 million. So we don't mind if we lose 10%, because it only takes an 11% gain to get back to where we started. Even if we lose 20%, that's a 25% break even. But when you start losing 30, 40, 50% of your money, 60% of your money, when you're 50, 55, 60 years of age, and you don't have the kind of time that the younger folks do to recover, that's kind of a problem. And this is kind of an interesting table that we were showing clients for the last couple of years. But this is the worst market decline by decade going back to the Great Depression. So in the 20s, the worst decline was 45%, we'll call it. I'm rounding. The 30s, obviously, the Great Depression was rough, down 83%. I hope we never see anything like that again. The 40s were pretty bad, but the 50s weren't that bad at all. 60s pretty bad, 70s obviously pretty bad, 80s, but then the 90s, 19.9% was the worst decline, not so bad. The 2000s, we had two declines, 47% and then 57.8% in 2007, 8, and 9. The 2010s, the worst decline was only 19.9%, just like the 90s. In fact, in 2017, the market didn't go up or down by more than 2% once, which is crazy. That's just not normal. So in the 2020s, we have no idea what's going to happen. But I think that mean reversion is a real thing, and I think we just have to make sure that we're not exhibiting recency bias, and we have to keep our eyes open and pay attention. And this is from Sentiment Trader. This is call it a continuum of investor behavior. So the black line is the average cycle, and the blue is this blue? I'm colorblind, Jess.
Yes, it is.
Okay. So all my charts are red. You'll see they're not red and green. It's all red and blue. But anyway, so this is the current cycle. You get the big waterfall decline, you get the big drop or the big bounce. And then you kind of have this point, and this is, again, this is not a prediction. I don't know if this is what's going to happen, but this is what typically happens in a real market crash. You get this disbelief, like, oh, it's going to come back, everything will be fine. And when if a decline begins again, then you get panic. Then you get people who are literally just depressed, going, man, I thought things would get better, but I don't even know what's going to happen anymore. I give up. Then they stop looking at their statements. They never want to be in the market again. Maybe they sit in cash for the rest of their lives. So obviously, really tough. Last thing I want to talk about today, and then we'll take questions, is what can you do today if you're a business owner to lower cost and improve your 401k or other retirement plan at work, because it's so simple steps. But let's focus on 401k. I'm going to keep this super simple because I don't want to take too much time. The first thing you can do is make sure that your 401k has exchange traded fund options in it instead of mutual funds, or at least in addition to mutual funds, that you have exchange traded funds, or what are ETFs for short. Mutual funds and ETFs are both baskets of investments. So we can buy baskets of US stocks, international stocks, growth value, bonds, currencies, commodities, anything we want in both mutual funds and ETFs. The difference is the average cost is extremely different. Average mutual fund, last I checked, about 1.6% per year, and you never see that fee. It comes out of your returns before you get your statement in the mail. The average ETF is only about 0.5%, and the portfolio that we use is, I believe, last I checked, I think it's like 0.21% or something like that. And mutual funds are all in all the time. In other words, it doesn't really matter whether the market's crashing or not. They have to stay in. If you pull up a prospectus for one of the mutual funds you own, it'll say something to the effect of the XYZ mutual fund must stay invested in domestic stocks at 90% or more at all times. ETFs are that way too, but we manage exchange traded fund portfolios because they're less expensive, and then we use our trend following approach. Mutual funds trade at 4 o'clock. If the World Trade Center went down and the market closed for a few days and it opens up in the morning at 9:30, and you're like, man, I don't want to be in the market anymore. When you sell your mutual funds at 9:30 in the morning, you have to wait until 4 o'clock and then you get your price. Whereas ETFs are traded intraday. So it's kind of like a stock. You want to get out of the market at 9:35 in the morning. It might take a minute or two, but if the market's just crashing and parabolically, but you're out right away, you can go back to going for a walk and doing the other things you want to do without worrying about your money. And then this is kind of a famous statistic, USA Today. It's pretty much the same, give or take 5% each year, but 80% of mutual funds underperform their benchmark. And when you're buying ETFs, you can buy the benchmark. So if I summarize this, one of the things you can do in your 401k at your company tomorrow, or at least this year, and to kind of get ahead of this, to reduce your costs and efficiency, is to simply make sure that you have exchange traded funds added to the plan so that it can get less expensive, understanding that you'll pay less for an 80% chance of winning in the long term if you do nothing else. And then another thing, some laws have changed this past year, and we kind of got ahead of it a couple years ago. I teamed up with one of the top payroll companies in Central Ohio to build what's called a multiple employer plan, or a MEP for short, and then a custom group price plan. And one of the things you can do, and anybody can do this, by the way, Better Business Bureau could do it if you're listening, Kip. So you can add ETFs and proactive tactical model portfolios to your 401k, reducing your cost but adding value. You can get increased service and education for your employees. So executive concierge meetings for business owners, boot camp educational presentation for both employers and employees. And then because these multiple employer plans allow us to basically create a bigger footprint. So the way it works is, whether it's a group priced custom plan or a multiple employer plan, in either case, the ERISA is looking at these 401k plans as if 50, 100, 150 401ks are all in one plan. Now, to you and to your staff, your employees, it looks like any other 401k would, in that it looks like, for me, the Libertas Wealth Management Group 401k plan. But behind the scenes, from an auditing standpoint and a compliance standpoint, the fiduciary responsibility actually lies on the MEP from a plan standpoint, and then the investment liability, in my case, for my plan, obviously lies on me. So a safe harbor MEP, where you have to agree to 21 years to contribute, 21 years of age, that is, 1 year service, and basically an effective 4% match, so dollar for dollar up to 3.50 cents in the next 2. 85 basis points, or 0.85% per year, is the total cost internally. 1,000 a year is the only hard dollar cost, and $88 per participant. Custom plans with group pricing, again, completely custom. You don't want to have a match. You want to have a vesting schedule where, if you have a match, then the employees can't take it till after 6 years. You pay $500 more for the customization. It's the same $88 per participant, 85 basis points, for the plan internally. Or if you don't want to use the payroll company, obviously we can't do as good of a job from a cost standpoint. The value all stays the same, but the cost does go up a little bit if you have payroll in-house or if you're married to your payroll company. All right. At 11:54, I think I did it. Here's all the disclosures and mumbo jumbo that I have to include to make sure I'm staying legit. And I think, Jess, if anybody has questions, I'm happy to take a few.
We did get a question, and you may have touched on it. It came in a little bit earlier, but I'm going to ask it. On your comments regarding the emergency account, how would you adjust that advice for people who have a zero balance on a HELOC? I asked because
Sure.
I was considering depleting some of our emergency fund to get into the market while down.
Okay. I appreciate the thought process. I think that's really forward thinking. I think that's smart to be thinking that way, to think, okay, you know, market's on sale. Now might be a great time to deplete my cash and use it to kind of get a little juice on that money, as opposed to the measly, you know, 0.1% I'm getting in the bank account. Again, obviously with the rest of the presentation, I'd be really, really careful about getting into the market and chasing returns right now, because I'm not convinced that this market's, you know, healthy. But that all being said, I don't know that I would ever recommend anybody use their home equity line of credit to invest in the market. But to use that as a last ditch resort for emergency funds, I think that there's nothing wrong with that. I mean, if you're in a situation, your family's in a situation where you know, there's just cash flow issues at home, and you know, you're faced with either A, paying the bills, or B, not, then obviously dipping into the home equity loan makes a lot of sense. But in terms of investing that cash right now, and then using the home equity line as a B plan for emergency expenses instead, as long as you're a long-term investor, as long as you're pretty young, and that if this market were to head down another, you know, 20, 30, 40% from here, that wouldn't hurt you, then I think you're okay. Yeah, I don't think that would be a problem.
Great.
That it?
Let me just make sure. That was the only question that we've had so far. If you want, I think, so unfortunately I didn't find this out until after the fact, but we can add a handout to this webinar. So if you want to send me that checklist really quickly, I can drop that into this.
Sure.
And if anybody has any other questions, please feel free to ask. As I mentioned, we did record this webinar, so it will be available on trustlocal.org. If you have any other questions, please don't hesitate to reach out to me, to Adam, to, you know, BBB. We're here to help. We're here as a resource. We want to make sure that our businesses and consumers have what they need. So we are happy to, you know, help however we can. As I mentioned earlier, trustlocal.org also has a survey that businesses and consumers can fill out, letting us know what your pinch points are, if there's anything that you need, any resources that you're looking for. It also has all of our other webinars listed, so if you've missed one and you want to go back and watch that, you can do that on trustlocal.org. Let me just really quickly bear with me. I'm going to see if I've gotten any email yet, and I can drop that handout into the webinar.
I'll just wait you right now. You should have it.
Okay, great. And as I mentioned, if anybody has another question, please feel free to go ahead and ask, or if anybody has a follow-up question. I don't think I've seen any more come in. So,
and if anybody has any questions that they have that are personal or more private, or that, you know, as sometimes, you know, people are either afraid to ask a question or you don't know what to ask in some situations, you can feel free to email me. Our company email is on the screen there, info@libertaswealth.com. If you're interested in more of the nerdy stuff, I post pretty frequently on Twitter. So if you want to follow me there, and then you never have to be a client to ask a question. So, you know, I always joke that, you know, we're not really salespeople here. So, I mean, if we're more kind of educators, and we want to help people, of course, but, you know, if you have questions about any of this material, nobody's going to, you know, I always say that our interrogation room was replaced with a therapy room. So there's no swinging light bulb with the metal shackles or anything like that. So if you have questions, feel free to email me personally at adam@libertaswealth.com, and then Jess will get you that questionnaire if you'd like it.
Yes, so I just loaded that into the handout section, so you should be able to see that and grab that if you'd like it. And again, if anybody has any other questions, please don't hesitate. But with that, I just want to say thank you so much, Adam. It was great information, and you did it effortlessly. So we appreciate your time, and everybody, please stay safe, stay well. And with that, I think we'll go ahead and call it a day.
All right. Thanks so much, Jess. Appreciate it.
Thank you. Take
All right,
care.
bye-bye.
Bye.